We'll kick off, conscious of time and obviously conscious of the fact that this is a very, very broad area for discussion. So thank you very much, everybody, and welcome once again to one of our Raw Compliance webinars. Today, our webinar is going to be focused, as many of you are already aware, on trade finance and understanding really what is it that we can't get right about the money laundering controls within trade-based money laundering. What is the challenge to banks? Why is the cost of compliance so high? Is it a technology issue? Is it an issue in terms of the transactions themselves? Is it an issue of respective information sharing? We'll talk about all of these various aspects today through the presentation. So I'm very, very grateful to a number of esteemed guests that have joined us on the panel today. And first and foremost to Mr. Robin Lee, who's going to act as our moderator today. So if I may, I will hand it over to Robin, who's going to introduce all of our panelists. And once again, on behalf of Raw Compliance, I just want to thank you all for attending today. It really means a lot to us that you've come to support the community. So thank you.
Thank you, Una. And welcome again, everybody. My name is Robin Lee, and I'm the VP of APAC for Napier. Napier offers an AML platform which has a number of functionalities, including transaction monitoring, transaction screening, client screening, and risk-based scorecards, as well as many other things on top of that. On our wonderful panel today, and I'm actually gonna start off with ladies first. I would like each panelist to give a 30-second introduction. So let's start off with the hostess with the mostest, Una here.
Thanks, Robin. Well, some of you already know it. My name is Una van den Berg, and some of you may have known me as my previous name, Nizam, so trying to surprise you with my new name. And I am the Managing Director and founder of Raw Compliance, which is the compliance community that this webinar has been hosted by. The reason we created Raw Compliance was basically to give a platform for empowering compliance employees and our colleagues globally. One of the challenges we have seen is that information sharing really is lacking across the industry at a global level and local and an industry level. And information is not power. Information should be shared, and we should be empowering each other with knowledge, with learning, to support one another and to encourage innovation. And so that is the purpose why RAW has been created. It is social enterprise, it's a non-for-profit, and it really is just a global community for compliance. And obviously on the side, I also have a consultancy business, Virtual Risk Solutions, but the focus today is for RAW Compliance. So thank you all for joining us.
Thank you, Una. Next up, we have Nizam Ismail. Nizam?
Hi, thanks, Robin. Thanks, Una, for inviting me to be a part of this very interesting session. So Una and I used to work at a compliance consultancy previously. So I currently run Eticom Consultancy, which is a compliance consultancy based out of Singapore. As for my personal background, I used to be a prosecutor and then a regulator with the MAS. Used to be in compliance and legal roles in investment banks. And then used to head up the financial services practice of a law firm before starting my own consultancy last year. Yeah, so great to be here.
Thank you so much.
You, next up, we have Omar from Windward.
Hi, thank you. Thanks, Robin and Una, and for the respectful forum. My name is Omer Ilat, and I work for Windward, a maritime analytics company. For the past 5 years. I started as a project manager and moved on to different sales and business positions, mainly working with clients on different sectors and industries to enhance risk selection. Previous to Windward, with my personal background, I did not so long Navy career. So this is where I got my maritime background and expertise, which I'm hoping to share with our market.
Fantastic, thank you, Omar. And last but by no means least, Amar.
Thank you very much for everyone, Una, Robin, for inviting me today. It's a pleasure to be here. Briefly, my background, by profession, I'm a banker, so I do get involved in financial crime compliance advisory projects with a number of financial institutions. And also I run London-based Sigma Risk Limited, and we do specialize in offering bespoke training, risk assessment, and advisory services on financial crime compliance. One of our key area of expertise is trade-based money laundering. So we've had experience in delivering number of masterclasses and training sessions on trade finance and trade-based financial crime to a number of regulators, financial institutions, global corporates, as well as SMEs. So it's my pleasure to be here today, and I hope that we all enjoy the session today.
Thank you, Amar. Okay, so ladies and gentlemen, before we begin, just a couple of housekeeping rules here. This isn't your typical webinar. So at Raw, we don't offer typical webinars like everyone else. What the format of this webinar is such that it's a walkthrough. So that is, we will be running through slides, but we will encourage a bilateral dialogue between ourselves and you, the members of the audience. So if anyone does have any questions or thoughts or concerns or comments or anything throughout the session, please do either raise your hand, you can type something in the chat room, you can even unmute yourself and share that comment. And I know there are many very familiar faces that I see here in the audience who I know will have no hesitation whatsoever to do that. So we do encourage that. Thank you. Okay, so
also, Robin, if I may just, sorry, that note, this session is also recorded as well. And the reason why it's recorded is because we share it with all of the participants afterwards. If anybody has any challenges with that or wants anything afterwards deleted from the recording, please let us know and we can do that before sharing.
Thank you, Una. Okay, so in terms of what we will be discussing today, what this walkthrough will comprise of, we're gonna ask ourselves, what is trade-based money laundering? We'll then take a look at the challenges posed by product activity and role. We'll then identify some red flags in TBML and typologies. We'll then move into some pandemic-related challenges in TBML. Then we'll ask ourselves the questions, what are we getting it, where are we getting it wrong, and why? What tools can help? And last but by no means least, the roles of financial institutions and government bodies in fixing the problem. So before we jump into the slides, we actually have a poll. And so for those of you who aren't familiar with Zoom, if you look at the options at the bottom, you can select the poll. You can actually access the future polling questions as well. We're going to have 3 throughout the whole session here. So you can actually start answering the polling questions. But what we will do is we'll review each poll as we progress throughout the session. So the first one is, what is the estimated amount of money laundered globally in 1 year in US dollars? So what are the options? We'd love to see what the audience thinks here. So we've got less than 50 billion, 50 to 100 billion, 100 to 500 billion, more than 500 billion. Okay, so maybe what we'll do is we'll take a look at the poll here. So the answers are coming in here. I'll give it a couple of minutes, guys. Okay, it's looking on more towards the higher numbers. So we've got 3% on less than 50 billion, 10% on 50 to 100, 38% on 100 to 500, and 48% on more than 500. What are your thoughts there, Nizam?
Looks like we have a room full of compliance folks.
That's great. That's great. How about yourself, Amar?
I think I'm actually quite pleased to see that that a lot of us actually do understand that there is quite a big problem, and then I think that the answers which are reflective of our understanding that this is a bigger problem, and then you see the last 2 options between 100 to 50 billion and more than 50 billion. That is pretty much 80%, pretty much actually 85% of the participants they're thinking, I think, on the same line as we think. So I think I'm quite pleased with that.
Right, right. Omar? Omar?
Yeah, I think that 90% of the world's trade is being carried by the global IMO fleet. So I think that we're speaking about a tremendous amount of transactions, and obviously the exposure is large.
Okay, and Una.
Well, I think it speaks for itself. Talking about statistics, and one of the things that Amar was saying, previously when we were preparing for this session was, from a global level, we're looking at between 1.2 to 3 trillion, US dollars a year that actually is being facilitated through this. So it's a massive problem. It's a significant problem, and the question is, why is it a problem that we can't seem to solve at the moment? And I suppose that's exactly why we're here today, to have that discussion.
Right. Okay. So let's stop sharing this now. And then let's move right along and kick it off to what is trade-based money laundering? So Una, you want to take it away?
Yeah, what happened to the screen? Did we get some somebody drawing on the screen today? we've got some scribbles on the screen. So what I think what we're talk about, it's actually really interesting, and it was something that Amar and I were actually discussing the other day. We all talk about trade-based money laundering, but first and foremost, before we jump into the regulations and the problems, do we actually really understand what trade finance is? And then obviously, do we understand what trade-based money laundering is and how these two fit together? And Amar, I don't know if you want to comment on this as well. I think this, in the trainings that we have seen and many of the discussions we've seen, we always jump into the challenges, and it's really important that everybody is on the same page and has the same understanding of what we're talking about before we start talking about it.
Certainly, I think the most important kind of aspect for us to, if we want to win the battle against financial crime, is to really understand what we offer, what product and what services do we offer, and exactly how our products and services do operate actually. So if we don't really understand that, what are the key stages of our product offering when we offer in the market, and then where could be the possible gaps. So just jumping into a training and then talking about high level compliance, that is one of the issue, is that we're not really correlating our own product and services with the regulatory requirements. So it's very important for us to first understand what we offer, and then we should be able to solve the problem.
Absolutely. And I think one of the things to remember as well, and again, we'll talk about this later on, is the fact that banks themselves, financial institutions, play a relatively small role in the percentage of finance that's actually given in trade-related activities. If you look at it as an overall percentage. And so, when we're talking about, well, what's the challenge? What is trade finance? The difficulty that we have is a lot of the challenges exist not because it's something the banks can't control, but it's stuff that is outside of the bank's viewpoint, or indeed outside of the bank's, what the bank is seeing in respect of their place within the transaction as well. Nizam, would you have anything further to add on that?
I think we were getting to it. I think the uniqueness about international trade finance, I mean, obviously, it is a very global phenomena. But I think also from the bank's point of view, when you look at the risks involved in a trade finance arrangement, I think we'll go to that in the slides later on.
Yep.
But there are multiple parties involved. There's a question is who is your client, and that depends on your role. In a very complex financing arrangement, you could have different clients, and you're exposed to different sets of risks, more so than a very local offering. So that makes it more interesting.
Okay, so I suppose obviously in the next slide we're looking at, well, what is trade-based money laundering? And obviously this is where transactions are obscured, or indeed documentation is altered to remove even what is actually being transported in terms of the knowledge, or indeed modifying the value, etc., of what's being what is actually being moved in the trade transaction. So it's obviously a very, very serious issue that at the moment many governments can't solve. And it's actually a very interesting statistic, and we'll talk about it later on the number of containers that are actually searched. And you'll begin to see for yourself, we know that the problem exists. We know that there is, for example, I was at a conference last week with regards to wildlife, illegal wildlife trading. And they were talking about, what we can do to identify typologies. And then the question was, well, what enforcement action actually exists around this? And again, we would see these products being transported through different trade mediums. And the response was, well, there's actually some legislators who have no enforcement actions currently on their books, and they've actually not taken any enforcement action for money laundering purposes, specifically with regard to illegal wildlife trading. So it goes to show you that we know that this is all happening, and we talk about it, and we're training on it, and we're looking at ways in which we can improve. But again, if the enforcement action isn't happening, and there isn't actually that action happening in the background with the regulators, with the enforcement bodies, etc., practically what can we do to stop this? And I know, Amar, maybe I'm jumping ahead because we're going to talk about this later, but is there anything further you wanted to add with regards to, what is trade-based money laundering?
Certainly. So I think let's go back to the definition we always come across, that there has been actually the trade-based money laundering has been defined by Financial Action Task Force. So what I did, I took the privilege to kind of to split it into, I think, 7 bullet points. So it's simple as that, and it is complex and simple at the same time. If you don't understand, it's very complex. If you do, it is simple. We can definitely kind of understand it, and we can have sufficient controls in place. So simply, as what Fatah says, is a process of disguising. So we need to understand this is actually a process. So it's a process of disguising the proceed of crime. Okay, another I think distinction we need to make here is kind of proceed of crime and moving value through use of trade transaction. So there are a number of ways that criminals, they can actually move the proceed of crime. So in TBML specifically, what we're focusing on, that the moving value, could it be product, could it be cash, or any type of value. So when we try to hide behind a legitimate trade transaction, we pretend that it is a legitimate trade transaction, but the motive behind the trade transaction is actually we are actually up to something else that we don't really appear to be showing, in an attempt to legitimize the illicit origin. So as long as we understand that it is a process, and then the motive behind this particular activity is to hide behind a legitimate looking global trade. And one thing that I will like to mention here, that a lot of the times generally we classify that anything that is coming up in trade finance is kind of very risky, is we a lot of the time it is looked at suspiciously, but the majority of the times, in my opinion, these transactions will be genuine transactions. I think 80-90% of the time it will be genuine, but there will be those small percentage of maybe 5% or something like that, where the motives might not be actually actually a legitimate trade, but trying to hide behind and facilitate movement of goods or service from place A to place B.
Yeah.
And the next slide, I think where we will try to, yeah, okay, 1 second, it's coming up. Okay. Just 1 second, I'm just getting control of the slide now. Just bear with me. Okay, due to some reason, I can't control the slide from my end.
Yeah,
can you do that? Okay. So if you can control, Robin, so that will be helpful. So, well, let's try to understand a little bit, why do we actually need a trade finance anyway? So in a normal trade transaction, when we have, two parties who want to engage with each other, like importer and exporter, once they have a, very well-defined relationship with them already, so they can easily, trade with them confidently. They don't need a bank to come and finance a trade transaction. But here, for example, what we see on the screen, so for example, we see there is an importer who is based in a particular country, right? And there is an exporter who is actually selling a commodity which is needed by the importer. So the problem comes when importer does not really know who the exporter is. So they just, for example, found them on the internet, for example. And the exporter in return, they don't know who the importer is, or there is not that degree of comfort or relationship in between both of them already. So that is when the banks come into the picture, when they play a role representing both importer and exporter. And then banks can bring the degree of confidence through number of trade products, for example, letter of credit and the bills of collection and standby letter of credit, etc. So this is just giving a background as to why do we even need the trade finance. It is mainly when the importer and exporter, they want to leverage from the confidence that they have when there is banks involved in the transaction. So can you move to the next slide, please? And then, of course, the shipment can take place. Thank you.
So I think
we've already covered on this one. Yeah. Una, you taking this slide?
No, I was going to say I think we've already covered this one as well. Just kind of, and again, in terms of the authorities, this is from the US perspective. One of the things that they have said is that they believe that the challenges as well is that there are limited resources at a customs level to really prioritize the identification of illicit trade. And again, as you mentioned, Amar, earlier, we're looking at around between 5 to 10% of the overall trade volume that would have something potentially suspicious within it. And if you look at the number of containers, for example, you would see on a daily basis going through international, shipyards, for example, Singapore, Hong Kong are two very good examples. Which one of those containers do you open? Which one of them do you look in? And it's not just a matter of opening the doors of the container, there's the boxes inside, and then obviously looking through the boxes. So a lot of time, the heavy reliance is actually placed on understanding the documentation that supports the trade and looking at the relevant parties involved. And again, that poses its own challenges as well, especially where agents are used as opposed to the direct parties. One of the things we've also seen with regards to smuggling, in particular bulk cash smuggling, is there's an increasing usage of shell companies. And again, as we know, as most of us will know, having worked in AML and especially in CDD, KYC, understanding the purpose of a shell company, who's behind it, who is the beneficial owner, why is it sitting within a corporate structure, this type of information as well is something that we would need to know. But again, as I said earlier, the challenge we have is that banks don't always see the full front to end of the trade transaction, nor all the documentation. They see a specific part that they potentially play a role in. And the challenge they have is they may inadvertently be associated with one of these shell companies without actually realizing it, because it's not visible, whether it's a correspondent banking relationship, for example, or indeed through the provision of other services. So this is what's incredibly, incredibly challenging about this. And even though, as I said, the government agencies acknowledge that there is failings in many respects, and some of them also sit with the resources and the capabilities of the customs officers themselves.
Yeah, I think a point I would like to make, this report that we see on the screen from the USGAO, this is actually an excellent report, and I would recommend all of us, if you haven't read this report, so this is available on USGAO website. And actually, I was actually personally interviewed by GAOA when they were actually for formulating this report in March this year. So you will see that the depth of investigation that USGAO they has actually performed, and the step they've taken to compile this report, that's very amazing. I think all of us, we should benefit from this particular report. We should definitely.
Absolutely. So Robin, then on to the next slide. So I believe, so are you going to talk through this one, Amar?
Certainly. So of course, the question I do get asked a lot of the time, is trade finance risky? So I think the answer is yes and no at the same time. It is risky if we don't know what we're getting into, okay, and if we really understand our product, if we understand our clients, and if we have sufficient knowledge and control framework in place, then we can sufficiently mitigate the risk as well. There are some reasons, I would say, that may kind of make it a little bit more riskier than any other banking product. I think the reason for that is involvement of number of parties and number of stages that we come across when we actually explore a trade instrument, compared to a normal bilateral transaction where there is a buyer and a seller and they agree on a transaction. They do believe in each other, which we call it open account transaction, and all they need to do is agree with each other, and the buyer will make a payment to the seller. So that is a very simple process, but it has their own sufficient a number of risks involved as well from financial crime perspective, which we will discuss later on. But when we come to trade finance, so I do have actually a slide explaining for example the LC and how does it work actually, and then we'll try to understand what might be kind of the aspects of the complexity that may make it a little bit riskier than any other financial product that's offered by a financial institution. Robin, can we move to the next slide, please?
Sure. So before we actually move to that slide, Amal, we actually have a poll here. So let's everyone get their poll screens open. So the question is, what percentage of global trade is actually financed by financial institutions, i.e. trade finance? So we've got 50%, 80%, 20%, and 70%. So let's see what we get here. Okay, it looks like the 20, oh, it's a toss-up between 20 and 80% here. Oh no, 20% has the edge here. Hang on.
Keeps moving.
It does, huh? Okay.
And everyone, please feel free to ask questions as well. You know, that we want you to get as much out of this also. If there's any questions you have, please feel free to ask them in the chat room, and then we can discuss those as we go along also.
Okay, so I think 55 people have responded. That's good enough here. So 50%. So for 50%, we have 16% of the audience. For 80%, we have 29%, and for 20%, we have 33%. So that's the winner. And 70%, we have 22%. So it's quite a mixed bag here between 20 and 80, almost equal. Comments from the panel on this. Hey Nizam, we haven't heard from you. Actually, no. Let's go to Omar. We haven't heard from you in a while, sir. I'll get to you after Nizam. Don't worry.
So I think it's actually fascinating because we've been working with financial institutions right now around the trade operations, and I've learned quite a lot from a few engagements. I think that when we speak about the challenges in terms of what needs to be done around these transactions, I think the discussion is always around we have too many trade transactions, either from credit or open accounts, and it's simply not scalable to enhance due diligence without any automation around them. So I think yeah, that's quite fascinating.
Okay, Nizam?
Not so much on the poll results, but just to add on to the theme, just before this, on the issue of complexity of trade finance transactions and the risks that are present for financial institutions. I think in a trade finance situation, I mean, the level of complexities just increased. Apart from the issues of who is my client, you have to deal with risks posed by the goods that you're dealing with, that you're financing. You're looking at various other parties in a complicated or in a complex trade finance transaction, other financial institutions, other parties. I remember when I used to be in a bank, I actually had to talk to the folks in customs because at that point in time, there were issues about the extent to which that banks or financial institutions were expected to conduct due diligence on the goods that were being financed. And it was quite scary because, okay, well, financial services is all about, risk management. But here, I mean, the question is, how far down the road do you look beyond whatever's in the documentation?
Yeah.
Okay, we'll get to dual use goods in a while because that has its own set of problems. But, how far does a bank shut its eyes to the obvious? If there were a lighter shade of red, do you close your eyes? Do you not make inquiries? So those are the things, and how do you actually operationalize that? And you can get to very technical issues that, that calls upon very specific technical expertise on the part of the compliance officers. So these are actually levels of complexities, levels of risk. So the bank needs to decide risk appetite in such a scenario.
Thank you. Una, would love to hear what your response to this poll.
No, I have to say, I totally agree with what Nizam was saying there. And I would just add to it as well. And again, what Nizam was talking about is to, going down in the different layers. Even, at the point of identification, some of our systems just aren't fit for purpose in respect of identifying the issues. Like if we look, correspondent banking, I appreciate is, maybe slightly outside of this, it is impacted by this. The systems that we have are looking at the names as parties to the transactions. On the correspondent banking side, you actually don't identify irregularities unless you identify that needle in the haystack that you need to look at, pull it out, and then start looking at the paperwork around the transaction. And so, the challenge you have here is there are certain banks who inadvertently get exposed to these issues when they didn't necessarily have the information to hand as part of the transaction and the facility they were providing. And that's something that I find incredibly challenging. Our systems, our monitoring systems aren't prepared and aren't adapted for that currently, but yet we still expect the banks to be able to identify something which the systems themselves aren't picking up out of thousands of trades or thousands of transactions that go through the books every day.
Okay. Faisal Anwar in the chat group is asking Nizam to speak louder. So next time, Nizam, we need you to come closer to the mic. But last but not least, Amar.
Sorry, I was on mute. So, okay, yeah. So specifically, first of all, talking about this poll, so I think I'm actually surprised that most of us, at least we remember two figures, 20% and 80%, but the difficulty is that which one belongs to what. So I think that's what the message that we're getting. It's quite common to see that we talk about 20-80%. So the correct answer is, of course, that 20% of the global trades is actually financed by trade finance, where 80% is open account. But again, from both of them, what we need to understand is each of them at the end of the day is part of the trade transaction, be it trade financed by the bank or just processed by the bank. And each of them, they do have their own risk associated with them as well as some of the benefits. So I think we've got another slide where we'll talk about what is the difference between open account banking, where we represent actually 80% of the global trade compared to the trade finance. And each of them we will briefly discuss as well as to what are the key, I think, mitigating factors with each of type of the finance global trade, as well as the key risks involved. So I think that there might be a slide. I think there is a slide actually coming up.
Right, and we'll come to that in a second, Amar. Just one more thing. We got a comment here from Tak Chan. I think one of the key areas is how do you screen MT messages for fake data with the intent to commit fraud, which a lot of times gets rolled into money laundering, and how blockchain will ultimately resolve this major issue. So Tak, I would say stay tuned for that, especially later down the line when we discuss blockchain. I think Nizam's going to provide some really amazing insights on that. So just put a pin in that for now, and we'll get there. So I'm going to stop sharing this, and then I'm going to move on to the challenges posed by product activity and the role. And we're coming to that very slide that you mentioned just now, Amar, about complexity of trade finance and open accounts.
Yeah, I think, of course, let's briefly talk about what is open account trading anyway. Open account. It's rather simple compared to the trade finance. So we simply have kind of, an importer and exporter, and they want to buy and sell from each other, and they just agree on the terms and conditions. And when they have the terms and conditions agreed on the details of the trade, exporter will ship the goods and present the document as an evidence, and in return, importer, they will actually make the payment. So this is a quite simple process compared to trade finance, but it does have some challenges from the banker's perspective, because in this particular scenario, all the bank has in front of them is that all they are doing is just they are processing a transaction. So they do not have an oversight as to, for example, what is the underlying product. Okay, they don't know what the quality is, they don't know what the quantity is, they haven't seen any shipment document, etc. So in a normal open account transaction, all the bank is doing is they are simply processing a transaction. So I think that the good thing is that one of the mitigating factor in an open account transaction is that both of the banks on buyer and seller side, they have a valid KYC. They know who their client are, they know what do they do, they have an idea about the transaction background and history. But the risk is that in this particular way of global trade, where it's the open account transaction, they do not have deep access to the transactional level details. So if there is something which is kind of not up to what we want to deal with, it is difficult for a financial institution to quickly spot that if there is something that they don't want to deal with, because we don't have access to the trade details and the documents. Okay, so now we move on to trade finance. So the first one was quite a simple one, where we just an open account transaction, simple between buyer and seller. So now take an example here now. So for example, there is an importer and exporter, and they agree on a contract. Okay, we are buying and selling product A and B, and they want to benefit from a trade finance product, which we call a letter of credit. So the way it will work is that an importer, they will go to their financial institution to open a letter of credit in the favor of the exporter. So you see they already got one importer and exporter involved, and then one issuing bank who will actually issue the letter of credit. The letter of credit will be issued, and then advising bank, they will advise after checking all the details to the exporter, and that we are happy to accept this transaction. So now we have 4 parties involved already and 4 stages. So once the exporter, they have received the confirmation from the advising bank, which is number 4, exporter will make a shipment. You see the vessel going, taking the product, shipment will be made to the importer, and the exporter in return, they will send the documents as an evidence to the advising bank, say, hey, I have actually shipped the product, now I want reimbursement. So once the document is produced, advising bank has checked the documents, so advising bank will make a payment to the exporter. So the exporter side is all covered now. But then what advising bank will do, they will send the documents to the issuing bank as an evidence that we have made the payment to the exporter, and they will demand payment from the issuing bank, which issuing bank will do. That's number 9. And then the issuing bank will present the documents to the importer as an evidence that product has been shipped, the payment to the exporter has been made, and they're through their respective bank. Now the issuing bank will demand their payment as well, or if they, which most of the time importer will already have an account with the issuing bank, or they will simply deduct from their account. So what we see here, compared to a simple open account transaction where a bank only handles the transaction, they just process the payment, here we have 11 stages. Is still at the end of the day is simple one transaction where we have an LC involved. So we have 11 steps, and this is how the product and then the screening that needs to be performed. And actually next screen that we will talk about who are the parties which are actually involved in this transaction. For example, I call it the most simple diagram, because even in this diagram we have one importer and we have one exporter, and Nizam, you need to keep clicking. So we do have issuing bank, we have advising bank, we have confirming bank. sometimes that's needed as well. The shipment company, we have a vessel involved who's going to take the product. We will have a captain of vessel. This is tricky because if we have the information about the captain of the vessel, that need to be screened as well. This is a requirement from the screening perspective. So we will have an insurance firm involved, port of loading where the goods actually going to be shipped from. There will be a port of discharge as well where the goods are going to be offloaded, and we possibly there might be another place where the goods going to be ultimately delivered. And there another aspect is the certificate of origin of the product, because that is from the sanction screening perspective we've got to be aware of. So what we're looking at from here is that a simple one transaction, say for example, shipment of sugar from country A to country B. If we have a letter of credit involved, so we are talking about 11 steps and around 11 or 12 parties which are involved in it. And this is, I call it, a most simple, because what if there are multiple ports involved from port A, B, or C, or there might be sometime, what happens, there are multiple banks involved, or sometimes what happens is that within the journey from place A to B, a product might be sold multiple times during the journey as well. So that is how the trade finance becomes, a complex product that is offered. So it is absolutely important for us to understand how does a product works and who are the key parties which are involved, and how we perform a risk assessment, how do we perform screening as well. So I think that is the answer to the question. Is a risky product? It is risky, but risk can be managed if we understand what we're dealing with.
Yeah. And
thank you for that. Okay, we got some comments here in the Zoom chat room. First one from Sairam, who says that open account transactions constitute more than 80% of the overall trade, and lack of documents and details for such transactions is the biggest concern in my view, while banks are more focused on trade finance, which has a better controls in terms of KYC, transaction monitoring, and documentation. Sorry, TM and documentation. And then another one from Ben Jassim. I know a bank that requires a letter of declaration that a remittance is not related to money laundering, and even requires supporting documents such as invoice for a remittance done over the counter. But from the same bank, such documentation is not required for remittance done online.
Yeah.
Any comments from the panel on these?
If I may just make a comment here, and I'm going to actually pass it over to Omar to kind of comment on this. And one of the things that Amar mentioned was about, in the simplicity of this diagram, one of the things is that the ship just goes from A to B. And in reality, that's not the case. Apologies, I've had to switch my camera off, but the connection kept flickering, so it was getting a bit much for some people. So one of the things, Omar, obviously you've seen this quite a lot, when obviously people are contacting yourselves at Windward about tracking these vessels. And again, one of the things that we struggle with in banks is when we see that vessels have stopped at numerous ports along the way, we're having to check to understand where the goods have gone, which countries they've been in contact with, to make sure that there's no sanction violations, etc. Obviously you deal with this issue day in, day out.
Yeah, thanks, Una. So I think if there's if I take a step back from either trade finance or open accounts, I think if the highest value problem that worth putting focus on is having that capability for independent validation. So obviously in trade finance, as you mentioned, there's a need for validating every stage of the transaction since the goods are loaded throughout the course of the vessel. If it stops in multiple ports, sometimes, as Amar mentioned, it might be much more complicated. So there's a need for having that independent validation, things that can reduce the load on trade operations team and actually help avoid the risk along the way. I think in open accounts, if we look at the need for independent validation, the challenge is, not mainly around how do you digitize documents and how do you make sense and analyze risk out of them. I think it's the same challenge with open accounts with only much more limited information. So for our clients, at least what we're hearing from the market is, how do you get the full context of each client, and in some cases relating to specific vessels, but most of the time for commercial entities, how do you get the full context of their behavior? How do you move from ticking the box on specific screening checks to actually analyzing the behavior of each client throughout the way, so it will indicate on such a risk? I think that could be the focus around how to use technology and look at these transactions and monitor them.
Actually, got some interesting comments. Well, one comment in the chat group and one to me privately, but this is about the same thing. So Sean Pinto has asked me, could you give some additional info on why a captain of ship name should be screened? And then Faisal's made a comment saying interesting to see that the captain of the vessel could also be a quote unquote party of interest for screening. So by corollary, if the shipment is made by air or by road, would the pilot or the truck driver also be similarly screened? So we'd love to hear the panel's thoughts on this.
I think when we, I think when we go to the captain, so once we, I have actually read through some of the OFAC guidance, and it is explicitly mentioned there that, you know, if this is not an information we need to go and get hunting for. So if the information is available, then we should screen that, because the issue has been seen a lot of the times when some of the vessels, particularly they have not been up to the good things, right? So they've been involved into evading the sanctions, and the captain sometime as well. So one captain might be involved in, you know, taking multiple, you know, vessels throughout the year or over the course of his time, where he might have been identified as a person of interest who has been leading the vessel to either, you know, to some of the ports which were not kind of, you know, desired, or maybe sometime in the activity like ship-to-ship transfer, etc. So if this information is available to screen the that we have the name of the captain, then there is an advice to screen the captain as well. But again, the question is that when we talk about, you know, truck driver, etc. So again, similar, I would say, is if the information is available. So I haven't read anywhere if you need to screen truck driver, but from the captain perspective, at least there is something that we have become aware of. We have read it. We've seen that some of the advisories. The information, if it is available, then we screen that. If it's not available, we're not obliged to go hunting for the information.
Okay, thank you. Okay, I'm going to move on now to our next poll, and this is on container inspections. So what percentage of shipping containers are actually inspected to validate the legitimacy of transaction invoices? So let's see here. I've got less than 2%, more than 60%, approximately 35%, and exactly 15%. So let's see what we get with this here. Kind of results we're getting here. Wow, less than 2% seems to be taking it here, guys. 62%. Anyone want to comment on that?
So I think this was one of the comments. Sorry, go ahead, Amar. Go ahead.
Go ahead, Una. You go ahead.
I was just going to mention. Actually, I was taking your comment anyway. You were the one who made the comment previously about the fact that, you know, less than 2% of the containers are actually inspected, and this is acknowledged by government officials, as I mentioned earlier, and it is one of the challenges. You know, as I said earlier, you don't know what's in a container unless you actually physically go down there and open the doors yourself and open the boxes and see what's inside. And that has been one of the biggest challenges over the years in the cost of compliance with regards to trade finance and trade-based money laundering, is that where do we stop in respect of our internal reviews? You know, and there are some organizations out there that have actually removed themselves from conducting trade-related activities and financing trade-related activities, because the cost of compliance is just too high, and the cost of compliance is outweighed it. So this is, quite an interesting statistic here, that only less than 2% of the containers are actually inspected, but yet what the expectations are in the banks in terms of compliance and looking through transactions that we're not even party to, it's incredibly onerous if you look at that across the board compared to other transactions that we have KYC and AML requirements around. And Amar, again, you were the one talking about this previously, so I'll pass it to yourself.
Thank you. So I think, yeah, when you go to the answer, that's the right answer. And now some people, they do ask me a question, why is it that only less than 2% actually containers are inspected? So I think my answer to that always is that it is literally not possible to really kind of inspect 5, 10, 15%. There are millions of containers which are shipped every year. So imagine opening the containers, as you mentioned, Una, and then opening the boxes, then we're done with the trade. So I think one thing that we can do, if we are sitting in a financial institution, for example, we are in a way a gatekeeper, so we can identify some red flags. Okay, from the client behavior, so the history of the client, and then in our dealing with the client. So a seasoned individual who has been dealing with a particular client, a particular product or service or geography, they might be able to identify red flags. And once you've identified a red flag, then we can work in partnership with the public bodies, for example, the custom agencies or the law enforcement, and we might be able to share some information that this is a particular transaction which we might think that may not be a legitimate transaction, and then we could focus only or pretty much 1 or 2% of the transaction which are the illicit transactions, and identify that through our knowledge and expertise of our clients' product and service, and we can work in collaboration with our law enforcement to make sure that those 2% which we are picking up are the ones we really want to pick up. So briefly talking about the red flags, so as I mentioned, someone who's a seasoned individual, they should be able to identify red flags in different stages and kind of aspects from a financial transaction. Could it be from the goods perspective, or we may be able to identify something that's maybe odd when it comes to the documentation or the jurisdiction perspective. Payment is another thing. Payment instruction, payment route, that is something that we might be able to identify if there is something that is not up to the standard. Overly complex transaction structure, or the parties who are actually involved within a transaction, or there could be any other I call it miscellaneous red flag that we might be able to identify. So as the mentioned, when we do perform these kind of the training for our clients, so we dig into each of these different type of red flags as to what we can identify, what we should be watching about. For example, today I will briefly talk about the red flags from the goods perspective, for example. So if you move on to the next slide, please, Robin. So even if you just talk about one aspect, so in the previous slide we've seen 7 or 8 different kind of aspects where we can identify red flag. Let's talk about the good. Okay, so are we confident? Do we understand our client, that if we are handling a trade transaction, for example, a letter of credit, are we able to understand if the client might be deliberately, they might be hiding exactly what they are trying to ship, right? So this is one of the typologies that we talk about. Origin and destination, does it really make sense at all? So I have seen personally a transaction of a large shipment of sugar from one of the Asian country to Brazil. But actually, Brazil is one of the biggest exporters themselves. So it doesn't really make sense for Brazil to be importing the sugar, right? So packaging, one of the very interesting transactions that I have actually dealt with, there was a shipment of frozen fish from Iceland to Nigeria. And just performing some due diligence, we got a couple of kind of kind of concerns about the transaction, we just looked into the vessel that had been named, which was taking the shipment from Iceland to Nigeria, and that vessel did not have any freezing system. They don't have any capability to take frozen product from place A to B. So that fish you take from Iceland all the way to Nigeria, it will be all rotten, because they didn't even have any capacity to store in a frozen environment. So quantity, quality, do we have enough information? I do come across a number of the time the transactions where they only say that the value of the transaction is 200,000 US dollars. But we need to understand, okay, 200,000, what is the quality of the product? What is the quantity? Just a value on its own, an absolute value, that does not really give us enough information. Unit pricing doesn't make sense at all. Handle the transaction where a t-shirt was actually valued around, I think, 380 US dollars. It might be one of the high-end designer brand, but it was a bulk shipment, so we identified that, okay, that price doesn't look good at all. Or they could be dual use good. The clients might be trying to kind of not really giving enough information. One of the transaction, I can give an example I personally dealt with, where the product was declared as the raw material for tobacco industry. It could be anything. We don't know. Raw material is raw material. So from the dual use good perspective as well, we should be able to understand what the product is itself. If you screen raw material into the best available dual use good checker in the market, you're not really going to get anything meaningful out of that. Or shipment of container, does it make sense at all?
Yeah.
Sure. And I think Nizam wanted to say something on dual use goods as well, right, Nizam?
Yeah, I mean, it presents particular risks and problems for compliance in particular. Well, a dual use goods could be a goods that's commonly used in everyday life, like aluminum, but it could also have a military application. So it is a red flag. And the issue with dual use goods is that sometimes you don't know whether something is a use goods. And part of the problem is that a lack of universal treatment on how you describe dual use goods in documentation. And also, I mean, you might need to have very specialist knowledge to understand certain things. Another example would be drones. They can be used for normal application, or there could be certain types of drones which we could have military applications. And the risks for the financial institution is, again, where do you draw the line? What is acceptable conduct? What is not? And do you actually have a database of dual use goods? I mean, there's some international conventions on that. But by and large, the problem is that you could still end up in a situation where there are lots of false positives in dealing with this. So, yeah.
Absolutely. And so, Robin, just say, I'm quite conscious of time now. I know that the webinar was due to run to 6 o'clock. I think we probably will run over by about 15 minutes or so. So if the participants are happy to stay on, that would be wonderful. But if at any point in time that you need to drop off, please feel free to do so. We won't be offended. We appreciate that we're the ones running over here. So, but thank you for staying on, to all of those that do.
Thank you, everyone. And thank you, Una. So now we're going to be moving on to pandemic-related challenges in trade-based money laundering. And
okay, so let's briefly talk about. We do understand that trade finance is a rather complex product that we offer, and there are some challenges that we have identified that we do face when we offer this particular product. But now the pandemic has actually kind of made things a little bit more difficult for us now. So what I have done, I have highlighted some of the key areas which are adding to an already kind of struggling kind of fight that we are trying to win. So from screening perspective, for example, we have seen that due to in this pandemic condition, number of staff members of the financial institution, they are either working from home, number of them they're off sick, or some of them they don't have access to from the technology perspective. Like one thing that I have realized, because I do get involved in number of projects, the number of financial institutions who have their operation center into the countries like of India and Pakistan, Bangladesh, and the Asian countries. And the technology availability might not be as good or reliable as to some of the developed countries. So a number of the times, those operation staff based in different countries, they do struggle to access the bank system. So the ability of a financial institution to perform screening checks on, for example, the whole of the Swift message, that is becoming very challenging. And then one of the way around that I have seen that is currently being adopted by some of the financial institutions as a risk-based approach, that they have reduced the number of checks they perform. For example, if they used to screen whole of the Swift message, now they're screening only the top 5 or 7 fields. So this is, again, might be acceptable on a risk-based approach, but this is one of the challenges that we are facing. Again, document checking from the working from home perspective, trade finance is a very document heavy product that we offer from the financial institutions. And most of the time, the physical document is actually checked by the operation staff. But when the operation staff members, they are working from home, their ability to perform those physical checks has been significantly reduced. We've seen a number of issues from the counterfeit goods perspective. Face masks and gloves, they claim to be on a particular quality, but they're not. So there are a lot of claims that are coming in the market as well. Remote contact, the social distancing, most of the times, if a relationship manager used to visit their client twice a year or 4 times a year, they are kind of struggling to actually do that right now. Trade misinvoicing as well, due to the price fluctuation. What we are seeing is that a lot of the times, it is kind of used as an excuse now to kind of exploit the the supply and demand, and ask anything that they want, thinking that we can always walk away, saying due to the price fluctuation we have actually we charging more price. So fraud, and from a corruption perspective as well, there's a number of issues that we are seeing which are coming purely from the COVID-19 perspective, which are actually adding to the difficulties that we already face due to the complexity of the global trade. So what we have is that a couple more examples of the red flags that we've seen. So on the screen, we've seen some of the major news that has broke out. Number of government officials, they are actually abusing their power and kind of fiddling around when it comes to the services. Comes to the, sorry, my little one has just walked into my room that represent the DVC what we've seen. So I'll sort him a little bit. Yeah. So okay, so what we have seen is that for example, in Colombia, one of the agriculture minister is actually under investigation, because what he was doing is that the millions of dollars that had been allocated to fight the pandemic, that's been kind of fiddled around through fake transactions of the global trade. So Una or someone, if you want to cover the next slide, then I will be back on that in a second, please.
Thank you, Ashati. I have to say, I like that that Omar's and it totally real today. That normally happens to me when the kids come in at home. So at least, or it's a cat or a dog climbing on top of the table or something. So one of the things that's been really interesting on the trade-based money laundering side has been COVID has actually exposed in some other areas, fraudulent activities. Again, a lot of for example, high-end goods markets, or some certain businesses that have previously kind of reported certain levels of profit. Because of the shutdown and lockdown of the pandemic, they haven't been able to do that. But obviously, as a result of the pandemic, there has been an increase in the demand for certain products, masks, sanitizers, gloves, etc. And people have been combing globally, manufacturers, to try and find these products. And the challenge we have is that, are we really in a position now to go back and double check that everybody that now is claiming to be, supplying these products is actually a person that's producing it at a wholesale level? And as one of the things Amar mentioned as well, there's a lot of goods that are being put into the market now that are far below the quality than the expectation of quality in the market as well, which again is not a kind of a counterfeit, so to speak. It's the fact that these products are being moved around. So it's an incredibly challenging time, and more challenging because the market has become saturated with certain products because of the demand. And again, there's not necessarily the information at hand at this point in time to verify who in fact are the exporters that we should be looking at to deal with these products. So Robin, if you want to just move then to kind of the next few slides, where and why are we getting it wrong? On this here slide, we've actually put together, and these are actually some real examples of US trades from various countries where products have been individually priced. So you can see here, for example, that cut emeralds from Panama were priced per product, per piece at or per carat at $974 per carat. Okay, does this make sense? The next one obviously then was on the cordless telephones, which were priced at $4,000 per cordless phone. So you have to really look, when, earlier today, Amar was talking through like all of the red flags and, the over invoicing, under invoicing, all of that type of information. But one of the other things that we struggle with within a compliance perspective is understanding the actual retail price or the wholesale price for certain products. And there are indices that we can look to, but especially when you get quite illiquid products, it's very difficult to get a standardized pricing for them as well. Some of these ones speak for themselves, in the respect of, the cordless telephone, each phone costing $4,000. Of course, that is ridiculous. But, some of these other areas, you may not necessarily be experienced in the actual price. Well, how much does a machine gun cost? How much does enriched uranium cost? You would have to look at indexes, commodities. You'd have to look at different trading volumes, and for pricing to understand the price that these should be trading at. And so these are some of the challenges that we do have day to day, and that's only part and parcel to the actual transaction itself is the pricing of the product. So I think moving on to the next slide, conscious of time, we're obviously here, tools primarily, we're focusing here on technology. And this is where, if I may, hand it over to Nizam, who is one of our blockchain and should I say, fintech, regtech experts. So Nizam, if you wouldn't mind just talking about blockchain potentially as a solution within trade-based money laundering.
Yeah, I think it is quite exciting, and I think credit to the banks, the consortium that actually worked on the blockchain product here in Singapore, to actually pilot blockchain-based registry to facilitate trade finance transactions. So that's really great. I mean, just a bit of a 101. So the blockchain is there. It is a permanent audit. There's a permanent audit trail. It's tamper-proof, and of course. You don't need a central authority. You can have different nodes to legitimize or authorize certain aspects of the transaction. So it's square on, very relevant in a trade finance situation when you talk about legitimacy or creating credentials for who the initial parties to the contracts are. The whole transaction becomes tamper-proof. And you can get it validated by different nodes or represented by different sets of intermediaries in the whole transaction. Is it the Holy Grail? I don't know. I mean, is it necessarily bulletproof? Of course not. I mean, somebody can hypothetically pretend to be someone else and steal somebody else's credentials, and the whole system could, in a very perverse way, perpetuate that. But you have to have an element of trust that your KYC processes are robust enough to mitigate against those sort of risks. But I think it's a great example of leveraging on technology to mitigate the risk. It doesn't eliminate it, but I think it mitigates it quite significantly. There.
Brilliant. Mic drop. And Omar, from your perspective as well, obviously, you guys, I know at Windward have been looking at this as well in terms of the holistic, not just with regards to sanction screening for the ships, but holistically at ledger capabilities, etc., for front-to-end transactions.
Yeah, I actually agree with Nizam. I think blockchain can be a great solution for, how do you deal with duplication of documents and how do you assure the integrity of them. And I think taking a step back and looking at the entire transaction, I think what technology can do, it cannot solve the entire solution, cannot replace anyone in that area, but I think it can help in remove the burden of data gathering and processing and make time for, you know, middle office and back office and compliance functions to focus on actual risk analysis. And you've mentioned here, and the Amar mentioned, you know, multiple documents, multiple entities to screen, multiple transactions for each entity that financial institutions actually bank. And I think technology can really be leveraged where you let it deal with the data processing and fusion with different sources, but it needs to go up to the extent of, you know, getting that client risk or transaction risk and considering all the aspects that we've mentioned, right? So, and at the end of the day, it's not to say this is to find that smoking gun, but it's to, you know, do the heavy lifting around on things at scale that would leave you enough time to say, this is something which is unusual compared to other transactions for the specific client, or compared to, you know, any other entity which is involved in a specific transaction.
Thank you for that. Now we're going to move on to the roles of financial institutions and government bodies in fixing the problem. And over to you, Una.
Yes, so there are government initiatives underway to try and look at ways in which we can, you know, should I say fix? I don't think fix is the right word, but begin to strengthen the standards and the transparency in the governments in respect of trade-related activities and move away from paper-based processes. Singapore, I have to say, has been at the forefront of this, and incredibly proud to say that as well. A lot of the digitalization work they've been doing, not just across the banks, but also across the industry. And even just this month, there actually was a government parliamentary discussion specific to this, where they said, look, you know, we need to start to look at digitalization, and this needs to be something that we start immediately. There's also some other global entities, government and NGO entities that are currently looking at this as well at the moment. As I mentioned, US Customs and Border Protection did a proof of concept on blockchain back in 2018. As we saw, Standard Chartered DBS, a consortium of 14 banks, as Nizam mentioned, worked on this earlier this year in Singapore. And then on the next slide as well, one of the things that's incredibly important was a discussion around, would creating a code of conduct fix the problem? Would that be the solution to improving transparency? But one of the challenges here is about buy-in from lenders. The lenders need to insist that they only lend to people who buy into the code. And again, also what we have to remember as well, that there are entities that are reluctant to disclose not just their financial arrangements, but also their trading parties. And this lack of transparency and disclosure also can lead to problems as well, because we don't necessarily know who everybody is dealing with. So would a code of conduct fix things? Would it fix the cultural issues that surround trade? I'm not so sure. Would automation and moving away from the paper-based process solve the problem? It would help. It would help incredibly. Are we there yet? I think we're a long way from there. And we're looking at a 2, 3, 4 year window to build this. And this success will only happen if we get buy-in across the board from all of the parties. And as mentioned earlier, only 20% of the financing actually goes through financial institutions. The other 80% is actually done through open open sources. So, who do we need to get involved here? Is it the regulators? Is it the governments? Is there other international bodies that need to be playing a role in this? The answer is yes. Everybody has a role to play here, and we need to come together. But the unfortunate thing is, for example, even if we look at the recent kind of KYC utilities that have been looked at, when we do have great ideas as an industry and we come together, they don't always necessarily work out. But this is a big problem that needs an international audience, not just a country audience, to fix it. And I'm not so sure from, with inter-country disputes, the amount of sanctions we're seeing nowadays for political games, I'm not terribly sure if we could get to a stage where we fix the problem. But I think that there's a lot of things we could do that we could go a long way towards helping with the problem. And I know, Nizam, you were nodding a bit there. I know you've kind of been looking at this in a lot of detail, especially around the digitalization, as you mentioned. Did you have some comments on that?
Yeah, it's one of those issues which is really hard to address. I mean, when you talk about conduct and culture, people tend to dismiss it as being, very fluffy. You can't really put regulations around that. And to some extent, it's true, having been a regulator myself. But just stepping aside for a bit, I think here in Singapore, the MES has since, and it's not just a Singapore focused issue, but the MES has put in place requirements for financial institutions to look into conduct and culture. So that has become more prominent. It's become more front and center because I think we know from a lot of even the AML issues that have surfaced in the past, a lot of them were because of conduct and culture issues. So that's one dimension of it. The other dimension of it is when you look at all the other participants, which are non-banks, what can we do about this? Well, actually, there is a parallel because we have actually now, impose or require AML standards from non-bank players like real estate, corporate secretarial firms, lawyers, accountants, and other professional bodies. So I think it is not inconceivable that this requirement to do a KYC is extended to other non-bank intermediaries, so long as they pose a significant or a material money laundering or terrorist financing risk to the whole ecosystem. So that's my take on it.
Thank you, Nizam. Okay, ladies and gentlemen, before we leave, we end the session. We do have a final poll, and the question for this poll is: do you think we can mitigate risk in trade-based money laundering to an acceptable level? And here we have the responses. So yes, with the right technology investment. Yes, with the right public-private partnerships and information sharing in place. No, because it's not just a banking issue. No, it's really too broken and fragmented, and better bespoke training as well.
Sorry, I confused you there, Robin. We threw that one in at the last minute. Sorry.
No worries. No worries. So let's see where this is going. Oh, we have tremendous support for public-private partnerships here. At 63%, 64%. Okay, so 68% on public-private partnerships, 33% on technology, 17% on no, because it's just a banking issue, and the rest are marginal. So training is only 10%, and no, it's already too broken and fragmented at 7%. Any final thoughts from our audience members here? Sorry, not audience, our panelists here, sorry.
I'll just quickly comment that I'm an optimistic person. So I truly believe that we can solve some of the heaviest challenges around trade-based money laundering. I do think that technology is key, but I think it's not enough. I think domain expertise is needed. And even when combined together, this is not to say that technology will be the solution. It will be just another tool as part of the resources that financial crime fighters have in order to address.
Thank you, Omar. Nizam, you've been both public and private.
I mean, that's my previous life, so I've lost all my superhero powers. But I think just to share, I think I'm a firm believer of the public-private partnership. I think I can speak about Singapore because that's a jurisdiction I'm familiar with. The MES has put in place a platform called ACIP. I can't remember what it stands for, but that's recognizing the need to engage the private sector on AML issues. I think it has done a lot of good things. In relation to trade finance, actually, the MES has worked with the Association of Banks to get more granular guidance to financial institutions on what they can do to mitigate, trade finance and money laundering risks. So I think that's probably the only way to go. You need to have that open engagement, that constant dialogue to get everybody on board, everybody own the issue. So it's not just a top-down approach. So I'm a big fan of that.
Fantastic. Amar?
I think we're all on the same page. Especially, I think, in my opinion, personal opinion, yes, technology is definitely going to play a very significant role. It can really make things more efficient and easier for us in fighting a good battle. But again, I agree with Omar that that's not going to be the only solution, which is always going to resolve everything. Public-private partnership is definitely a key. To look forward for us to work together with the law enforcement, work with the customs and the financial institution and our clients themselves. I think one thing that I would still mention is the training. I have actually reviewed 4 thematic reviews have been performed by UK FCA, Dubai DFSA, MAS and HKMA. And one particular point that has been identified by each of them is that the training for the trade processing staff and the compliance staff who deal with the trade finance, that has been very generic. They hadn't been bespoke. Okay, so this is a specialist area. This is a complex product or service that is being offered. So the training has to align with the complexity. So the example, the scenarios, case studies, everything that has to be part of the training that is being provided to this specialist area. So I think that is one of the things area where we've been lacking a lot, and it has been highlighted by the regulators across the world.
Okay, thank you, Amar. And then last but not least, Una. And Una, I'm going to hand it back over to you, just in the interest of time for all our attendees here, so you can comment and wrap it up as well. Thank you.
Thank you, Robin, and thank you for all your moderating today. It's been wonderful. Really, really appreciate it. Completely agree with what everyone has said, Omar, Nizam, Amar. And one of the things as well, I would comment on is about, information sharing and knowledge. We know what's broken, and I'm optimistic that if you know what the problem is, you'll find a solution. But again, we all need to be on the same level and the same playing field in order to look for a solution. And innovation is all about bringing different mindsets and view sets into this. So just on the point that Amar made there about training is so critical. You can't go into a training event and say, okay, guys, because you work in this area, here's the regulations, this is what the policy says, and this is what the procedures say. You can't start there. You have to start with the products. People need to understand the products we're working with, understand all of the relevant documentation, understand the risks that are exposed with the products. What are the red flags? And what the wonderful thing is, once you empower people with that knowledge, innovation begins to happen and people begin to think outside the box of ways in which they could help to identify more clearly the red flags through the documentation because they better understand it. And for me, that's such a critical area. There needs to be much more public-private partnership information sharing, and that's across the board. That's obviously not just for trade-based money laundering, and that will help us with typologies. But we actually need the people involved in this day to day to really understand the products and what they're doing. And that's actually something that stayed with me from very early in my compliance career. When I started, when I trained as a lawyer at the European Central Bank, I was asked to advise a monetary policy which impacted products, and I had no idea about products. And I learned very quickly, if I wanted to be a good compliance officer, I needed to learn products. And hence I went and joined the product development team at JP Morgan to learn products. And so again, just about training, it's not about the rules, it's not about the policy, it's not about the procedures. If you don't understand the products and you don't understand the risks, you're not going to be able to identify the red flags. You need to know that also holistically the front to end process and where your role is in respect of that specific document in the front to end process as well. So on that note, I want to say a big thank you to everybody. Thank you to every one of the speakers, to Omar, to Nizam, to Amar. Again, thank you very much to Robin for your wonderful moderation today and going through the slides. And also a big special thank you to everybody who's attended today and all the participants.